Welcome once again to Retire Well with Kevin Bucher and Pete Samanuk of the Citizen Advisory Group. I'm your host, Spike Spangle, and every single week we like to bring you retirement planning solutions. Kevin, how you doing this week?
I am great. Great to be here. Great to have Pete joining us on the show today. So,
Pete, this is your first time.
Super happy to be here. Yep.
Awesome. Tell us a little bit about you. How long you've been with
yeah, I've been with Citizen Advisory Group for 14 years actually, and in the industry for 14 years. So been a CFP for a handful of those years. I've personally known Kevin, his family, and our firm for 23 years. So they've been mentors to me my whole life.
Wasn't he a coach of yours back
in
high school?
Yep. Kevin was my high school wrestling coach.
How good was he?
Along with his...
he was good. So we like to pick on him, but he's good. So we have a lot of history that we go back, and there's a lot we can share and give Pete a hard time. But he was good, and he's a great advisor. He's a great asset to our team, and we've been very lucky to have him for the 14 years he's been with us.
So retirement is a team sport, and it's great to know that you've got a team and you're also building your own continuation plan here at the firm, making sure that we've got people who can help the entire area. So if you're seeing us here on this broadcast, we'd be happy to get you your own retirement checkpoint review. You can call the phone number that you'll see down at the bottom of the screen. Again, I'm Spike Spangle, so let's get kicked off on today's program. What I want to talk about is some of the changes in personal finance today. There's some big, huge breaking stories of this new year, so I'd like to go through them. Number one, starting out with a record-breaking year in annuity sales. Now, I'm not saying that everybody here or anyone even at Citizen Advisory Group uses annuities, but over $360 billion flowed into annuities last year. Coming in second to the year before that was $311 billion in 2022 going into annuities. Guys, why is so much money flowing into the annuity space? Let me start with you.
Yeah, sure. So we're just getting right off the gate with a super polarizing topic, right?
Yeah,
it's a
absolutely.
super polarizing topic. We like to use that when people hear that word, it's like nails on a chalkboard sometimes.
Yeah.
But I think that's for a lot of reasons. You hear bad marketing on them, you hear good marketing, and it's just like anything today. There's so much information out there. We don't know what to believe, right? There's good, bad, and different. And we do use annuities at our firm, right? We use them because they're a special tool, right? They fit a lot of situations and do a lot of things that other financial tools can't do, right?
Right.
Now, we don't use them in all situations. They're not appropriate for everybody. But it's not really a word that we shy away from because they are such an important financial planning tool. We just want to make sure we're doing what's right for people.
You are absolutely right. People have a polarizing and emotional opinion about this word annuities. And there are good ones, there's bad ones, they're sometimes not appropriate. But Kevin, would you agree that the annuities themselves have changed over the last 20 or 30 years?
Yeah, so I think there was two primary things that drove these big numbers for the past couple years. One of them has been just kind of the changing environment we're in, and I'll get that. But I think the other thing is there's so much uncertainty in regards to the economy and the market, and consumers are kind of crying out for something that's got a little more certainty to it. So annuities can certainly fill that gap because they do provide some guarantees and some certainty. But to your point, we're in a changing environment where we saw interest rates that have been held at historic lows for 20 years now, that overnight essentially shot up, and that has greatly enhanced the earnings potential and the income potential of some of the annuity products. So I think you're seeing money flowing into these products for those two primary reasons, that, hey, they're pretty attractive right now. We can get a pretty good rate of return, maybe just as importantly, a pretty good rate of income or withdrawal. At the same time, people are crying out for wanting to have something that's got a little more certainty to it.
And I think once people actually understand them a little bit more, right, they're highly misunderstood, they're confusing, they can be made confusing, but once people understand a little bit more, it really is what people want.
Can I ask you, what are you doing with folks who may have purchased annuities 4 or 5 years ago when those rates weren't as good? Are they just stuck in that contract? Is it possible to exchange? Is it worth doing, or are there often penalties?
Yeah, so there are often penalties, and that's one of kind of a misconception, but something that needs to be made clear a lot of times up front. But right now, Kevin, I might lead into you for this a little bit. We're kind of using the term like when interest rates are low, people understand the concept of refinancing your debt, right?
Right,
You might
your
have
mortgage,
a mortgage, right?
I hear that. You refinance your mortgage.
Right. So you've got a mortgage. You've got a mortgage that you took out 5 years ago at 6%, but now rates are down to 3%. What might you do with that debt? You might refinance that mortgage. We're thinking kind of the same thing when interest rates are up. You can refinance your accounts. Maybe some of those annuity accounts, those fixed rate things. You can kind of refinance your retirement and your retirement accounts.
Brilliant, brilliant. And so
Yeah.
what does that process look like?
Well, so it really comes down to the newer options that are in the marketplace because there's more interest potential that we can potentially enhance the features and benefits of the annuity by looking at the replacement. So if an annuity made sense for you 4 or 5 years ago, it is absolutely worth the effort of setting down and having that annuity reviewed because you might be able to take the goals and objectives you had for that product and enhance that. And what does that mean? Well, that could mean better earning potential where you're going to earn more interest, but it also could mean just a higher income stream that you'll get from that annuity. So that ties right into that refinancing concept that it might be time to refinance the fixed income portion of your portfolio to get into some better rates and better features.
Right. And would you say that this would be actually part of the retirement checkpoint review, that you don't mind taking a look at people's former contracts?
Yeah, there's really 5 areas to that, but this is certainly one of the areas of the financial checkpoint review. We're going to take a look at the investment portfolio, and we're going to look at your investment mix. How much risk are you taking? What is the cost of your investments? And put you in a better place in regard to your investments. But it's going to also include taking a look at your retirement income plan. Do you have a sustainable strategy to provide the spending you need for retirement? What is your tax strategy? Are you in the right tax mix? And are you doing things that you can do today to mitigate your long-term tax liability so that you're keeping more of your money? What does your insurance package look like, from health insurance to life insurance to home and auto? Do you have the right coverage at the right cost? And then finally, the legacy and estate plan, making sure that you have your estate set up to protect you and your family from the unnecessary cost of probate and so many other pitfalls in that area.
A very, very comprehensive checklist. So, hey, Kevin, Pete, we've got to take a very short break right now. Folks, don't go anywhere. If you call the phone number you see right here, you can get your own complimentary, no-cost retirement checkpoint review. You can claim yours by calling the phone number you see down here. As you can imagine, we're broadcasting all around the area, so the calendar fills up quickly. So call as soon as you can. Or, see if I brought my phone out here, if you open up your phone to the camera function and point it at the QR code, the black and white box down there, you can click on that. It's going to take you over to a landing page. You can schedule your appointment right there. More with Kevin and Pete of the Citizen Advisory Group when we get back, right after this.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the 4th worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Kevin Bucher of Citizen Advisory Group. If you have amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. This is one of the greatest tax windows in history. Now is the time to take advantage of this tax discount while you can. We specialize in retirement planning, tax mitigation, legacy planning, and so much more. Plan your retirement right. Call now for your own complimentary portfolio review and written financial plan.
Welcome back to Retire Well with Kevin Bucher and Pete Semenuk of Citizen Advisor Group. I'm your host, Spike Spangle, and hopefully you are getting yourself started on your own retirement checkpoint review. Today we're talking about all of the different changes today in financial services, what's going on. There's just so many different things in financial planning today that have changed so quickly in the last couple of years. Social Security. Let's talk about Social Security. Many Americans are taking it earlier than ever. Pete, again, I want to start with you. Sure. Is this a good thing, a bad thing? Are you agnostic about it? How do you feel about Social Security taken early?
Yeah, so we're certainly not agnostic about it because it really is. It's the cornerstone in one of the largest assets that most retirees in the United States are going to have, right? It's your biggest retirement asset. and our advisors aren't talking about it, right? We're not thinking about it. Well, we are as consumers thinking about it, but our advisors don't seem that anxious to give us real detailed and good advice on when to take it. And when we hear news personally that, you know, a lot of people are taking it early, we don't like to hear that, right? Because really Social Security, taking it early at 62, for whatever reason you did that, you talked to your brother or a friend at work, right, or something like that, or, you know, maybe the news scared you, right? You were scared on the news or something. It's rarely the right decision to take it early. Now, I'm not saying, you know, you always have to wait till 70 or delay it as long as possible, but rarely is taking it early the right decision. So it's certainly not news that we personally like
And
to
let's be
hear.
honest about some fact. We're living longer than we ever have. The sooner you take it, you lock in that reduction for the rest of your entire life. It can also affect your spouse. Can you explain to me, Kevin, why it affects your spouse?
Yeah, for a married couple, and then sometimes it can even be when there's a divorce situation, and even an ex-spouse, there's survivor benefits that have to be considered. So maybe it's easiest to just kind of think of a client example and how this would actually affect a household. So just recently worked with a couple where there actually was about an 8-year age difference between the couple. So husband was 8 years older than his spouse. Husband also was the more primary earner in the household. So he has a higher Social Security benefit than his spouse. So in that situation, it's a pretty clear-cut example of how important the higher benefit is for the husband in this instance. Because if the husband lives to just his normal life expectancy, and let's just say that's 78 years old, well, if he started his Social Security at his retirement age, which was 64, he's taking a reduced amount. And if he only lived to 78, wouldn't make sense for him to wait beyond that, because the break even, the math of Social Security, is basically going to tell us 80 to 81 is where the break even is. So he wouldn't have lived long enough. But because of how the survivor rules are structured, his spouse is 8 years younger. Her life expectancy does look better than his because of longevity in her family, her current health. So when husband is 78, 80, 81, wife is only 72, 73. And the way the survivor rules work, because her benefit is lower, if he were to pass away, she loses her lower benefit but takes over his. So it really just puts an emphasis on if husband doesn't take his benefit at 64, he delays in order to get a higher monthly amount for the rest of his life. It's not just his lifetime we have to worry about, it's the lifetime of his spouse.
Right, right. Pete, I wanted to ask you, so here at Citizen Advisory, when you guys are putting together financial plans, this is what you do every single day in the offices, you're constantly helping people. Rough numbers. How much by percentage do you like to have the Social Security be as part of the monthly income plan? 20%, 30%, 40%, 50%? Where are you comfortable with having Social Security be in that percentage of
Yeah,
income?
certainly. My actual answer to that is it depends on the individual, right? So every single household is different, and I think what you're going to get with us at Citizen Advisory Group is customized financial planning that's unique to the individual, right? So I could give you a number. I could say 20%, 50%, but the reality is it's just different for everybody.
Yeah.
It's different for my parents. It's different for Kevin's parents. It's different for the people I met yesterday.
So we can't just do what our parents or grandparents did.
No, you have to look at yourself individually and what makes sense for that person based on their unique set of situations. And let's be real, everybody is unique. What worked for your sister or your brother or your parents or your grandparents or your neighbor might not be right for you.
Yeah.
Right?
And I like to kind of think of it in this way, that the math behind Social Security is actually pretty straightforward.
Yep.
And there's software out there that we can use to kind of run some comparisons, and that's one of the offers we had today for callers. But the math of it is pretty straightforward, but it only tells half of the story, because then we have to go to the art side of financial planning and look at this individual's lifestyle, what their needs and resources are, and we have to pair together the math and science with that art. Because if I just look at the math, it's usually going to tell me one answer every single time, and that is you should delay taking your Social Security until the age of 70.
Yes, both people.
But that doesn't fit into most of the people we see's lifestyle. So we have to marry those two things together to try to get the best deal we can from Social Security, but then fit it into that lifestyle.
One of the things that I'm so surprised about all of the time is people think that their Social Security is not taxable. And my bigger concern about the taking it early, some people say, look, I'm 62, but I'm going to keep working for another 4 or 5 years. I'm going to take all of that extra money, I can save it, I can invest it. But when you start Social Security early and you're making a good wage, over $100,000, $150,000 a year, do you get to keep all of that Social Security?
You don't, actually, and that's a great point, Spike. You have what's known as the earnings limit, right? Until your actual full retirement age, you have an earnings limit on your Social Security. So if you were, in your instance, your example, you said you took it at 62, but you're still working full-time, you actually don't get to keep any of that benefit, but you're actually locking the lower amount in. So those are also...
Two negatives.
Right. So those are the unique things you have to look at and think, what makes sense for the individual? Are you going to keep working? What's my spouse doing?
And it's not just a Social Security decision. So I think too often we think about the Social Security decision in a vacuum. So we look at, okay, if I take it at this age, it's this amount. If I wait a couple months, it goes up a little bit. But it really impacts so many other areas of the financial plan, including your taxes. So if I can delay my Social Security in order to get a higher amount, well, I would take less from my investment portfolio from IRAs and 401ks. That is a much better tax scenario than taking my Social Security early to get a less amount, making up the difference from my IRA and 401k. I'm actually going to pay more tax and have to spend more money out of that IRA and 401k.
And how many times in financial planning meetings have you had to explain that before? How many times? And what do you do? Do you show it to them on paper? Do you show it to them up on a big screen in the office? Say, look, if we just reverse the order, you pay less in taxes and you keep more of your own money.
Yeah, and it's one of the things about the software that's available for one, but it's all math driven. So we can actually do the math and show you what you're giving up with a Social Security strategy that's not the right one for you from both an income and a tax standpoint. So that's one of the things that we're doing here is we're providing a Social Security comparison and analysis. It'll show side by side how much you might be giving up, how much money you're leaving on the table with the wrong Social Security strategy, and then doing the tax overlay on top of that so you can see a more tax efficient Social Security strategy.
And there is no cost for you to do the Social Security comparison for the viewers of your program? No cost on that?
No cost. So we have built our business by putting solutions together for our clients that fit with what they're trying to do, and the direct result of that is they do business with us and become clients.
All right.
So we are not afraid of doing the work first and then earning that business. And that's how we've built this business over the last 16, 17 years of doing this.
For those of you at home, it is that simple. You call the phone number, you can get your own Social Security comparison report. There's no cost to it. Look, we know that you can go onto ssa.gov. Type in your Social Security number. The hardest thing about doing that is remembering your password. You can see how much you're going to get in Social Security. But now do the comparison report to have that overlay of the taxes as well, to see exactly what your income could be like. Can you save more of your hard-earned money by taking Social Security at the optimum time for you and your family? Call the phone number you see here. More of the Retire Well program with Kevin and Pete when we get back right after this.
I have a bachelor's degree in education. I spent the first part of my working years teaching. I left the teaching world and went into a family business endeavor that eventually led me down to the financial services world. And there really is a lot of overlap between the two, taking comprehensive topics and breaking that into common sense, easy to understand framework, whether that was in the classroom or now in a meeting room with clients. There was a transition, but some of the skills from the education world transferred very well over into the financial world. By and large, people are very confused about the financial planning process. And oftentimes they kind of settle for the default outcome of that, of not really having control. One of my favorite parts of the process is putting the solutions together and then presenting that back to the client and seeing maybe some light bulbs going off to understanding things that maybe there wasn't a great understanding of before. Setting goals, working towards those goals, and helping them along this journey to having a more successful financial outcome. I do have an oversight role as well, where I'm overseeing other advisors. We work very well together in a collaboration where we bring different areas of knowledge and expertise to the table to really provide more comprehensive solutions for our clients.
Welcome back to Retire Well with Kevin Booker and Pete Semenuk. I'm your host, Spike Spangle. They are the financial advisors of the Citizen Advisory Group, and we're talking about some of the differences today in financial planning from even just 2 or 3 years ago. One more topic, we hit Social Security. We've talked a little bit about markets and different kinds of parts of things that are moving around. I think even a couple of shows ago, you hit on cryptocurrencies. Great.
Fun topic.
We have fun topics, but I would like to bring up long-term care. Today we are living longer than we ever have. That's the great news. But do we have the proper funding? Do our baby boomers, do our Gen Xers who are right behind them going into retirement pretty soon, are we saving enough to fund our own health care and the costs of long-term care? Again, you've been doing great here. What are some of the numbers you've seen on long-term care, Pete?
Yeah, so again, starting off with a pretty uncomfortable topic, right? And it is a super uncomfortable topic. And most of us choose not to talk about it. But the reality is 70% of people turning 65 today are going to have some sort of need for in-home care, assisted living, adult daycare, nursing care, whatever level of skill that is. 70% of people, and the reality is we're not prepared for it. We don't talk about it because it's uncomfortable. We don't want to think about it. Our advisors don't want to talk about it because it's a super difficult topic.
And it's the type of care that's not covered by Medicare. So I think a very big misconception that folks have is that, well, I have Medicare and Medicare is going to pay those costs. The reality is Medicare only is going to cover medical necessary things that are being treated for recovery. And the long-term care statistics we're talking about are not situations where we're dealing with recovery. It's assistance with ongoing ailing or ailments that you're not necessarily recovering from, where you just need assistance with your normal activities.
You just said 70% of Americans over the age of 65. I've got some other numbers. Over $320,000 will be spent on an individual going into long-term care. The averages continue to go up. It used to be the average stay was about 3.5 years. Now it's closer to 4.2 years. I had grandparents who went into long-term care. They were in there for 4 and nearly 7 years. If you just take your own nest egg, to do your own math, all right? Let's say you've got $500,000 in savings. You've turned on your Social Security for both you and your spouse. Your house is paid off. You figure, okay, we can draw that 2% or 3% or 4%. But if you take a $320,000 chunk in a 4-year period, it hasn't just hurt what you've got in life savings, it hurts your spouse as well. So are there ways to leverage the long-term care, ways to leverage what you have?
There are, and the point you make that's great, this segues nicely into what we were going to say, is that, you know, the cost of it, right? We all know what the cost is. It might cost you $100,000, $120,000 per year. So if you're a married couple and you've built your $500,000 nest egg, and all of a sudden a spouse, maybe you have a stroke or there's an early onset dementia at 65, and that spouse now needs 5 years worth of care, and that's going to cost $500,000. Okay, so you've now spent your $500,000 nest egg on care for yourself and your spouse or your spouse, and now that spouse passes away 4 or 5 years down the road. Well, not only are you losing that asset, right? You're going to have that asset depleted down to almost nothing because we've had to spend it on healthcare, but you're losing income at the same time. You're taking a cut in Social Security. Maybe you've got a cut in your pension benefit, right? You're not keeping both of those Social Security benefits. So it's super, super crucial in those instances to worry about preserving that asset, right? You have to leave something for the surviving spouse or your family, because that's typically who it's going to end up affecting the most.
Right.
And I think when we look at these average costs, one thing we're not factoring in is we're focusing on the cost of the care, but we're actually skipping over one of the side effects of that care or the cost of that care, which is the taxation. Because the bulk of today's retirees' dollars is setting in IRA and 401k accounts that have not been taxed yet. So as we're taking funds from those accounts, it's not just paying the bill to the facility or the care providers, we also are increasing our tax liability and having to pay the taxes. So it erodes that principle that we've accumulated for retirement much faster than what we think because of the tax bomb that comes along with that.
Yeah, I totally understand what you're saying. Again, let's just use a simple number. If you've got to take $500 out of that non-taxed retirement account, 22% tax bracket, you don't actually get to apply $500 to that long-term care facility. Maybe $410.
Exactly, right? Because the cost of that, like I said, if it's $100,000, going back to Kevin's example, you might have to pull $130,000 out just to receive $100,000. So it really does compound itself, and it illustrates the need to have some form of protection. Right?
20 or 30 years ago, individual long-term care policies were more popular. They became very, very expensive, and it's because the insurance industry figured we're living longer. So when they did the actuary tables, they're like, we can't afford to pay people, from $50,000 and pay them out $400,000. Solutions. I like to keep people positive before the end of the program. What do you do to talk about
so
this?
there are solutions. And I'm going to defer to Pete to kind of walk through some of that. But the traditional long-term care policy that we saw of yesterday, where you paid a premium, and if you never needed it, you got nothing back, those still exist, but it's very limited in today's marketplace, and there's alternative solutions for that.
Right. So, Spike, you mentioned the traditional long-term care, and that's where everybody has a bad taste in their mouth about long-term care insurance. We've heard horror stories. It didn't pay what we thought it was going to. My parents or my grandparents dumped all this money into it and they never got any benefit from it. The cost goes up every year. There's 100 horror stories we've all heard. But in today's marketplace, traditional long-term care insurance, the ones that if you don't use it, you lose it, it's actually quite uncommon. So people are using, insurance companies, individuals are using life insurance in unique ways. They're using annuities in unique ways. There's short-term disability policies. There's dozens of different routes that you can take in today's marketplace. And I'll tell you, for all of our clients, every situation is different. Everyone's unique. There's going to be at least one or two solutions that suits exactly what you're trying to do. There's options out there today.
Right. So through all of this, we do have to wrap up today's program. And Kevin, you're so well spoken on it. 5 different points on the retirement checklist. Does it include the long-term care planning?
Yeah, that falls into that risk mitigation category. And we have a team of advisors at Citizen Advisory Group that would love to work you through that process and see where we can make your situation better.
Kevin, thank you very much. Pete, your very first program, thank you very much for all of your information. I hope you don't mind coming back and joining us again sometime.
Excited to be here. I'd love to do it.
All right, folks, get your own retirement checkpoint review by calling the phone number you see down there in the bottom of the screen. Or if you've been scrolling through your phone as well, open it up to the camera function. Point it at the black and white box, that QR code, you can click on it. It'll take you over to our landing page. Thank you so much for watching. Kevin and Pete, we'll be back again next week.